a big push to make transmission of monetary policy more effective, the RBI has made it mandatory for all banks to link all new floating home and MSME loans to external interest rate benchmarks from October 1st, 2019. Let's do a three-point analysis to understand the implications of this move. 1. What has the RBI said really? Well, as per RBI's orders, banks can choose from among RBI's repo rate, Government of India's 3-month or 6-month treasury bill yield or any other benchmark market interest rate published by FBIL, which is the Financial Benchmarks India Private Limited, as the external benchmark rate. The interest rate on the floating loans shall be reset at least once in 3 months. Also, banks are free to decide the credit spreads over the benchmarks as they deem fit. Now, existing loans which are actually linked to the internal benchmarks like MCLR or base rate or even BPLR shall continue till maturity. 2. What will be the implications? Well, currently banks have been using the internal benchmarks like the base rate and marginal cost of funds based lending rate system for pricing of loans, which has been ineffective so far in better transmission. Undoubtedly, usage of external benchmarking will improve monetary transmission, that is, changes in the policy repo rate will be meaningfully reflected in banks' lending rate as well. Now, banks also have not been able to reduce the lending rates despite the fall in policy rates due to the deterioration in the health of the banking sector. With September 4 circular, banks will be actually now exposed to huge interest rate risk, and consequently margin will become highly volatile if they continue to borrow fixed and lend using the floating rate linked to an external benchmark. Now, the new diktat will also add a lot of volatility in the financial system. External benchmarking will largely affect home loans and MSME loans. Other retail products such as credit cards or personal loans, education loans or even passenger car loans have a fixed rate in India and therefore will not be affected. 3. Which banks or financial firms will get impacted the most? Now, retail and MSME floating rate loans are around 25 to 35% of the total loans for most of the leading banks. ICICI Bank has the highest share of the housing and SME loans, so will be impacted the most. IndusInd Bank has high exposure to the fixed rate auto loans and hence is relatively less exposed. HDFC Bank, with a highly diversified retail loan book heavy on personal lending, will be the least impacted by RBI stipulation. RBI's norms do not apply directly to housing finance companies or HFCs, but HFCs compete with the banks on home loans and will need to catch up with their banking peers on the movement in the home loan rates as well. HFCs like LIC Housing Finance and HDFC will be the most impacted.